Thanks, Chia. So in lesson 4, we're going to cover how to assess the need for catalytic capital. We've created a model to help you evaluate the appropriateness of providing catalytic capital in a particular investment. The model starts with the assumption that it's better, if possible, to create the same impact with commercial rather than catalytic capital, since commercial capital is much more plentiful and it's thus easier to raise. It reserves catalytic capital for the situations where commercial capital won't go or won't work. This model does not replace the other aspects of investment decision-making. It's an additional diligence step for catalytic investments. But it does help answer the question, which investments deserve scarce catalytic capital? The simplest answer to that question is those in which the potential impact cannot be achieved with any lesser implied financial subsidy. We define an implied financial subsidy here as the difference between the financial terms of the proposed catalytic investment and those at which a commercial or market rate investor, one motivated only by financial returns, would invest. Even for investors with 100% catalytic portfolios, the depth of the subsidy relative to market rates is a useful measure. We've broken the analysis into a sequential decision model. If the answer to every question is yes, you invest. If any question is answered no, the model suggests you decline to provide catalytic capital. But in that case, you might consider making a market rate investment if no subsidy is needed, or providing grant capital if the subsidy needed is too great. To illustrate the model, we'll use one of my investments, an example we introduced in previous modules, Sanergy, which provides toilets in slums, then upcycles the waste. So step 1 of the model starts with impact. Is the potential impact of this investment compelling enough to deserve scarce catalytic capital? That's obviously a subjective question informed by your areas of thematic focus, but you're looking for significantly greater impact than what you'd see in an investment that can attract commercial capital. There are 2 types of impact, direct and systemic. Direct impacts are life-improving impacts experienced directly by stakeholders in the enterprise. So an example would be improving health outcomes for people by providing clean toilets. Systemic impacts are indirect changes to a system created by investing in models that are disruptive or create new paradigms. An example is proving out a new business model that can be replicated by other companies in other geographies. The invested company may not capture most of the financial benefit of that, but the impact can scale dramatically. Sanergy has both direct and systemic impact. The direct impact is providing sanitation services in the form of clean toilets to a population that otherwise has, frankly, terrible options. And the systemic impact is innovating an end-to-end business model that could be replicated in other poor communities around the world. Step 2 is about whether this problem could be addressed with commercial capital. If so, the model assumes this investment should not get scarce catalytic capital. If commercial capital is not flowing to enterprises seeking to have this impact, we say there's a capital gap. And there can be many reasons why commercial capital won't flow. The risk could be greater or the returns lower than commercial investors demand. But sometimes it's about perception, not reality, as commercial investors follow received wisdom like it's too risky to invest in first-time fund managers, guidance which catalytic investors like Amy Brakeman reject. To fill a capital gap, you might seek to reach underserved populations or geographies, to de-risk novel products, services, or financing models, to provide a track record or adequate scale for a new solution or a new team, to support a business model that has greater capital needs or contemplates lower profitability than market rate, or an investment that requires more due diligence costs than what commercial investors would bear. But to address historical biases in capital allocation, like the marginalization of BIPOC investees in communities in the United States or immigrants in Europe. And you might identify other capital gaps. So the assessment at step 2 is, would the investment help fill a commercial capital gap? Sanergy was in its early days not attracting commercial capital, nor were any competitors, so it passed this test for me. Step 3 of the model is about efficiency, whether the implied financial subsidy is necessary to achieve the outcome. Of course, the investment pitch doesn't come with an identified subsidy. You've got to estimate the difference between what you will receive and what a commercial investor would demand. That's the implied subsidy. Then you evaluate whether the targeted impact could likely be achieved with a lower subsidy. If there are other successful enterprises backed by commercial capital, credibly promising similar or better impact, why would you provide catalytic capital? Well, you might do so if you predict the pure commercial enterprises will ultimately fail or require subsidy themselves. Or maybe you see commercially funded enterprises making impact trade-offs you don't like. Many impact business models have inherent trade-offs between financial return and impact, such as a business model that charges middle-class customers more so they can charge poor customers less. You may wish to fund an enterprise that promises to make those trade-offs with more emphasis on impact, recognizing that will hurt financial returns relative to commercial capital-backed enterprises. But if you feel the financial subsidy sought is greater than what's needed or you're willing to make, you'll likely decline to provide catalytic capital on those terms. I invested equity in Sanergy in its early days at a modest valuation. What made the investment catalytic was the high degree of risk at that early stage. It was unproven technology, an unproven business model, and an unproven ability to scale. So the risk was greater than commercial investors would accept, and I was not aware of any less risky alternatives to get the same potential impact. Step 4 is whether the investment avoids or mitigates market distortions. For example, if international development groups have set the expectation that a mosquito net should be free, consumers will be reluctant ever to buy one, even a subsidized one. That's a market distortion. What you're assessing here is whether this investment might distort the market by displacing existing commercial players providing the same goods or services to the same population. Market distortion was a big concern for my investment in Sanergy because international development groups had built toilets in slums, provided them for free for a time, and then abandoned them. This had distorted the market. It wasn't clear that customers would pay to use clean toilets, even though there were no municipal or commercial alternatives. This prior market distortion added risk to my Sanergy investment, but I did not think Sanergy was itself further distorting the market. In step 5, we ask whether the enterprise will likely need catalytic capital at a subsequent stage, and if so, whether there are realistic paths for the enterprise to obtain that capital. If to achieve the impact you seek, the enterprise will require additional catalytic capital to survive long-term, well, how will it get that capital if you don't intend to provide it? If you're investing at the seeding or scaling stage as a bridge to commercial capital, can you define progress milestones that would enable you to withdraw your investment and enable a transition to commercial capital at a later stage? I evaluated Sanergy as having a viable path to commercial capital after the model had been de-risked with catalytic capital. And finally, an optional step 6. So this model can be used in 2 ways: evaluating potential deals one at a time, or comparing potential deals to one another. It's easier to answer, can this impact be achieved at a lower cost, that is, at a lower implied subsidy, by comparing multiple alternatives, but that isn't always possible. If you do have more than one similar potential investment to consider, well, this is the step at which you do so. So that's the model. If your answer at each step is yes, the model suggests to invest. If at any step the answer is no, the model is suggesting not to make the proposed investment. It's best used as to compare potential deals seeking to have similar impacts in the same commercial capital gap, but it can be used one deal at a time. We've created a narrative guide to this model as a standalone resource accompanying this module, which provides a detailed walkthrough of the steps, links to relevant resources, and discusses the limitations and assumptions of the model. You'll find it in the resources section on Connect and at the bit.ly on this slide. So back to you, Dario.